I want you to take a second and just think about your checking account. Like, really picture that exact digital number sitting there on your screen.
Right, the one we all check constantly.
Yeah, exactly. And we are totally culturally conditioned to view that account as a vault, like this static, secure room where your purchasing power just rests until you need to buy groceries or pay rent or eventually retire.
But that digital vault is, well, it's a complete illusion.
It really is. Your bank account is actually a terminal.
Yeah.
The absolute second that capital hits your ledger, it is deployed. It is actively feeding this massive, highly interconnected financial engine.
Right. It's a continuous circulatory system. That capital doesn't just sit there. It's immediately subjected to the mechanics of global finance.
Yeah.
Right? It becomes the foundational liquidity that dictates corporate valuations. It funds the expansion of emerging markets. And ultimately, it underwrites the risk of the entire global economy.
And tracing the actual life cycle of that capital is, well, that's our mission for this deep dive today. We are pulling from some incredibly detailed source material, these excerpts from a book called The Invisible Machine, A Guide to the Global Financial Engine.
It's a fascinating breakdown.
It really is.
Yeah.
We're going to map out the exact mechanics of where your money goes, how it escalates in risk, and how this overarching ecosystem actually operates.
Yeah, we have to follow the money.
But to track a single dollar, we can't just start at your local bank branch, right? We have to look at the institutions that set the rules of gravity for the entire system, which means the central banks.
Because before capital can even seek a return, someone has to establish the baseline cost of time.
Right.
Central banks, like the Federal Reserve in the U.S. or the Bank of England, the People's Bank of China, they don't just manage currency, they manage the price of leverage.
Okay, let's unpack this.
Yeah.
Because the source text dives heavily into how they actually achieve that, and it moves way beyond just, setting a benchmark interest rate.
Right. They operate under this dual mandate, maximizing employment while maintaining price stability.
And doing that requires manipulating the money supply to smooth out the macroeconomic cycle. It's like, I like to think of central banks as the economy's thermostat.
Well, that's a good way to put it.
Yeah, like lowering rates to heat up jobs and spending, but cranking the rates way up to cool things down when inflation gets too hot. But we have to talk about quantitative easing, or QE.
Yes, definitely.
Because the popular narrative is that central banks just, print money to stimulate the economy, but mechanically it's actually an asset swap, right?
That distinction is crucial.
Yeah.
Mechanically, the central bank goes into the open market and buys government bonds or mortgage-backed securities from financial institutions.
So they're taking bonds and swapping them for cash.
Exactly. And when a central bank buys those bonds, they are artificially driving up the price of those safe assets, which mathematically forces the return on those bonds down to the floor.
Down to practically zero.
Right. So if you're an institutional investor and safe government bonds are now yielding practically nothing, you are forced to move further out onto the risk curve to find any meaningful return.
You have to buy corporate debt or
equities or real estate. Yeah. The central bank is mechanically forcing capital into the broader economy by making safety just too expensive to hold.
And conversely, when inflation runs too hot, they do the opposite, right? Quantitative tightening.
They let those bonds mature or sell them off.
Pulling liquidity right out of the system, raising the yield on safe assets, and sort of sucking capital back out of the riskier markets. It's an elegant mechanism on paper.
Very elegant.
But it requires commercial banks to act as the transmission belt. If the central banks are setting the gravitational pull, the commercial banks, your JP Morgan Chases, Bank of America's, Wells Fargo's, they're the ones actually channeling the water.
They are the transmission mechanism, yes. But we really need to address a structural misconception here about how they operate.
Oh, about the multiplier model.
Exactly. The classic model suggests a bank takes in $1,000 of deposits, holds a fraction in a physical reserve, and lends out the rest.
Right, that's what we're all taught.
But in reality, commercial banking is driven by double-entry bookkeeping. When a bank issues you a mortgage, they don't go down into their vault and check if they have enough physical cash deposits to hand you.
Wait, seriously? Because if they aren't matching existing deposits to new loans, they are effectively expanding the money supply independently of the central bank.
Yes, they are.
They are literally creating credit out of thin air. How does the system not just instantly collapse? Like, what stops a commercial bank from just writing infinite loans to generate infinite interest?
Well, if we connect this to the bigger picture, the constraint is not physical vault cash. The constraint is the regulatory capital buffer.
Okay, so regulations.
Right, frameworks like Basel III. They dictate liquidity coverage ratios and Tier 1 capital requirements.
So how does that look on a balance sheet?
When a commercial bank creates a loan, they create an asset on their balance sheet, which is your promise to pay them back, and they simultaneously create a liability, which is the new deposit in your account. The digital elastic band stretches.
Okay.
But regulations require them to hold a specific ratio of high-quality liquid capital against those risk-weighted assets. If a bank writes too many risky loans, the capital charge becomes too expensive, and that elastic band snaps back.
Oh, wow. So they are constrained by the cost of their own balance sheet, not by the literal deposits in the vault.
Exactly.
That is wild. So your local commercial bank stretches this elastic band, expanding credit and fueling everyday economic activity.
Right.
But as that credit moves through the real economy, turning into wages, corporate profits, consumer spending, it eventually pulls back up. People save. Companies retain earnings.
And that surplus liquidity has to go somewhere to find yield.
Which brings us to the first massive aggregators in the financial life cycle, pension funds.
Pension funds are the silent apex predators of global capital.
I love that phrasing from the text.
It's so accurate, though. We are talking about tens of trillions of dollars managed on behalf of teachers, municipal workers, corporate employees.
But there's a paradox with them, right?
Huge paradox. Their mandate is to protect the conservative retirement savings of the working class. But because of demographic shifts and the sheer scale of their liabilities, they actually require really substantial, consistent yields.
Just to ensure they remain solvent decades from now.
Exactly.
And because they are operating with these timelines of 30 or 40 years, they use duration matching. Like, they aren't just day trading tech stocks on an app.
No, not at all.
The text details how pension funds are actually the buyers behind massive illiquid real-world assets. They're buying commercial real estate portfolios, toll roads, airports, shipping infrastructure.
They lock up capital for decades to secure a predictable cash flow. And that cash flow matches the predictable retirement dates of their beneficiaries.
But the reality of the modern yield environment is that infrastructure and government bonds just aren't enough to fully fund those future liabilities anymore.
Right, which forces pension funds to become the primary liquidity providers for the much riskier, aggressive tiers of the financial system.
Like private equity and venture capital.
Yeah.
Which we're definitely going to dissect shortly.
Oh, absolutely.
But before we reach those aggressive tiers, we have to look at the retail side of the equation. If pension funds manage automatic retirement contributions, mutual funds are the gateway for active retail investment.
Firms like Vanguard, Fidelity, BlackRock.
Right. They manage the discretionary wealth of the everyday investor. And the core mechanism they provide is democratization through pooling. It's like, think of a mutual fund like a massive party platter.
A party platter?
Yeah, like instead of having to buy an entire super expensive cake yourself, you and 1,000 other people chip in a few bucks, and you get a tiny slice of every dessert on the table.
That's actually a great analogy. They solve the structural friction of diversification. Because building a properly risk-adjusted portfolio requires holding hundreds of non-correlated assets. Historically, that was prohibitively expensive for a regular retail investor because of the transaction costs.
Just way too many fees to buy individual stocks.
Right. So by aggregating capital, mutual funds allow you to buy fractional exposure to the entire global economy. But the more critical dynamic outlined in the source is the bifurcation between active and passive management.
Right, the active versus passive debate. Active managers employ literal armies of analysts to evaluate balance sheets, right? Trying to find mispriced stocks and actually beat the broader market.
But the data shows that net of their management fees, they consistently underperform.
Yeah, which has led to this massive rise of passive index funds. Funds that just buy everything in a benchmark like the S&P 500 completely automatically.
Yeah.
But there's a hidden consequence to passive investing dominating the market, isn't there?
Oh, absolutely. We have to consider the momentum loop it creates.
How does that loop work?
Well, when a retail investor automatically funnels part of their paycheck into a passive index fund, that fund blindly buys the largest companies in the index, regardless of their underlying valuation.
Just because they're big.
Right. And that drives the price of those large companies even higher, which then gives them a heavier weighting in the index.
Which forces the passive fund to buy even more of them in the next cycle.
Exactly. It completely removes traditional price discovery from the market.
Which perfectly sets up the vulnerability that the next tier of the ecosystem exploits. Because mutual funds, whether they're active or passive, they leave you entirely exposed to systemic beta.
Meaning market-wide risk.
Right. If the broader economy contracts and the S&P 500 drops by 30%, your mutual fund drops right along with it.
And institutional capital, recognizing that vulnerability, demands an escape hatch.
They want returns that are completely decoupled from the underlying health of the economy. And that demand birthed the hedge fund.
Hedge funds are essentially selling non-correlated alpha. Firms like Bridgewater, Citadel, Jane Street, they aren't constrained by the long-only mandates of a mutual fund.
They can basically do whatever they want.
Pretty much. They utilize complex derivatives, extreme leverage, short selling. A hedge fund might execute a market-neutral strategy like going long on one specific automaker they believe is undervalued while simultaneously shorting another automaker they think is overvalued.
So even if the entire auto industry crashes, they make money on the spread between those two specific companies.
Exactly. They're completely isolating the micro variables and stripping out the macro market risks.
Or they engage in global macro strategies, right? Betting on the shifting interest rates of central banks, geopolitical events, elections, currency devaluations.
And because they absorb such extreme complexity, they operate outside the regulatory safeguards designed for retail investors. They limit their client base entirely to ultra-high net worth individuals and massive institutions.
So what does this all mean for the fees? Because the friction there is the compensation structure.
Yes. The infamous 2 and 20.
Right. Hedge funds are notorious for this model, taking a flat 2% management fee on total assets plus 20% of any profits generated.
It's very lucrative.
But the source text explicitly notes that over a 10-year bull market, many of these complex hedge funds vastly underperform a basic, cheap S&P 500 index fund. So if the institutional capital is losing to the index, why on earth do they continue to pay that exorbitant 20% performance fee?
Well, what's fascinating here is that you have to view that fee as an insurance premium against volatility.
Really? An insurance premium?
Yes. Institutional investors aren't paying a hedge fund to beat the market when times are good. They are paying them to survive when times are bad.
Oh, I see.
The appeal is the specific capacity to generate liquidity and positive returns during a catastrophic market crash. It's an expensive structural hedge for a multi-billion-dollar portfolio.
But a hedge fund running a highly leveraged cross-border derivative trade, they can't just execute that on a standard retail brokerage app.
No, absolutely not.
They need institutional plumbing. They need the ultimate intermediaries of the financial world, the investment banks.
Investment banks, the Goldman Sachs, Morgan Stanleys, Citigroups, they are the toll collectors on the highway of high finance.
Toll collectors.
Right. They provide prime brokerage services. They act as the counterparty that physically lends the hedge funds, the capital, and the securities that they need to execute those massive short positions.
And their role extends far beyond just servicing hedge funds. The text breaks their advisory arm into two massive, distinct functions for the corporate world. First, the capital markets division. If a multinational corporation wants to build, say, a $5 billion semiconductor fab, they don't finance it out of operational cash flow. The investment bank structures and underwrites the issuance of corporate bonds or secondary stock offerings.
They connect the corporation's need for capital directly with the institutional investors searching for yield.
Right. And their secondary function is mergers and acquisitions advisory, M&A, valuing a competitor, structuring the legal and financial integration, securing bridge financing for a multi-billion-dollar takeover. It's incredibly intricate.
Investment banks really act as the architects of these corporate combinations, and quite often their most lucrative M&A clients are the firms executing the most aggressive restructurings in the entire ecosystem.
Which brings us to private equity. If investment banks are the architects of the transaction, private equity firms like Blackstone, KKR, Apollo, they are the mechanics tearing the engine apart and rebuilding it.
Yes, private equity operates on a very distinct playbook. Acquire a controlling stake in a mature company, aggressively optimize its operations, and exit the investment years later via a sale or an IPO.
Here's where it gets really interesting, though. The real mechanism that makes private equity so lucrative is how they finance the acquisition. We have to talk about the leveraged buyout, the LBO.
The LBO is a masterclass in financial asymmetry.
How does it actually work?
Well, When a private equity firm targets a company, say a $100 million company, they do not use 100% of their own capital.
Right.
They might put down 20% in equity and borrow the remaining 80% from syndicates of investment banks.
Like putting a down payment on a house.
Exactly. But the structural genius, or danger, depending on your perspective, is that the debt is placed onto the balance sheet of the acquired company, not the private equity firm itself.
See, that feels like a massive systemic vulnerability. The private equity firm captures all the upside of the equity appreciation, but the target company is the one legally obligated to service that massive new debt load out of its own operational cash flow. Why does the tax code even incentivize that structure?
Because of the corporate tax shield.
Oh, right.
The interest payments on that massive new debt burden are generally tax deductible. So by loading the company with debt, the private equity firm legally wipes out a massive portion of the target company's tax liability.
Wow.
It artificially inflates the available cash flow to pay down the principal. It's financial engineering designed purely to amplify the internal rate of return on that initial 20% equity slice.
Now, the source text is very careful to frame the impact of this model impartially. We really need to look at both sides.
Yes, it's a highly debated topic.
Supporters of private equity argue that this exact pressure, that heavy debt burden forces stagnant, bloated companies to become hyper-efficient. It forces management to cut waste, innovate rapidly, allocate capital ruthlessly, which ultimately strengthens the broader economy.
But the other side of that equation is the fragility it introduces.
Right.
Critics argue that stripping a company of its cash reserves and maximizing its leverage leaves it entirely exposed to macro shocks. If interest rates rise or revenues dip, the company just no longer has a buffer.
And critics point out that this model often leads to strategic bankruptcies, right? Where the private equity firm still extracts management fees while the underlying company defaults, costing thousands of jobs.
It's a dual-edged sword, for sure.
But regardless of where you fall on the ethics of the LBO, the sheer scale of capital required to execute them is staggering. Where does private equity get the hundreds of billions of dollars to buy these legacy companies?
Well, the source material reveals a really surprising origin for a massive chunk of this capital.
Insurance companies.
Yes. If we connect this back to your everyday life, look at your auto or homeowner's insurance premium. The fundamental mechanism of insurance is pooling risk.
Companies like State Farm or GEICO collect premiums from millions of policyholders.
Knowing mathematically that only a small fraction will ever actually file a catastrophic claim.
Right.
But the critical concept here is float, the massive pool of capital that accumulates in the time delay between when a premium is collected and when a claim is eventually paid out.
And they can't just let that float sit in a checking account being eroded by inflation. They have to deploy it. Insurance companies are essentially massive investment funds that happen to sell insurance policies to acquire exceptionally cheap capital. Because they need to generate returns on that float, they funnel billions of dollars directly into private equity funds.
It's wild to think about.
It is. Your monthly desire to protect your car's bumper is actively providing the leverage used in corporate buyouts on the other side of the world.
It perfectly illustrates the inescapable gravity of capital. It must always seek a return.
Always.
Private equity attempts to extract that return by restructuring the legacy companies of today. But capital always requires a new frontier. It needs to find the unproven, disruptive technologies of tomorrow.
And that highest risk, highest reward arena is venture capital. Firms like Sequoia Capital and Andreessen Horowitz, they operate at the absolute genesis of the corporate life cycle. When a startup is nothing more than a few engineers and a theoretical algorithm, commercial banks won't touch them. There's no cash flow to underwrite a loan.
None at all.
So venture capital steps in, trading capital for early equity. But the underlying mathematics of VC are entirely decoupled from the rest of the financial system.
Completely. Traditional finance operates on a normal distribution. You try to achieve steady returns and avoid catastrophic losses.
Right.
Venture capital operates strictly on power law distributions. A VC firm knows, mathematically, that 80% of the startups in their fund will fail completely. They will go to zero.
80%.
Yes. And another 15% might just return their initial capital or generate a negligible profit.
How does an entire asset class survive when the core operating procedure assumes an 80% failure rate. That sounds insane.
They survive because of the extreme asymmetry of the remaining 5%. The one or two companies in a vintage that actually achieve product market fit, they don't just generate a 10% return.
They return what, 100x, 5,000x?
Exactly. Because the VC firm purchased the equity when the valuation was near zero, the exponential growth of that single generational tech giant pays for all the failures in the entire portfolio combined.
Wow.
They are not investing in companies, they are indexing the frontier of human innovation.
But here's the ultimate twist, the mechanism that brings this entire deep dive full circle. Where do these venture capital firms raise the billions they deploy into these high-risk startups?
The limited partners.
Right. The LPs who supply the capital to the VC funds are the exact same institutions we started with.
The system loops entirely back upon itself. The capital funding the most volatile, bleeding-edge AI startup in Silicon Valley is sourced directly from the conservative, duration-matched pension funds of public school teachers and the massive float of global insurance conglomerates.
It is one continuous, inescapable ecosystem. I mean, central banks set the cost of time and manipulate the gravity.
Yeah.
Commercial banks stretch the digital elastic band, creating credit out of thin air.
Pension funds aggregate that wealth to secure the future.
Mutual funds lock retail money into momentum loops. Hedge funds engineer complex escapes from market volatility.
Investment banks build the plumbing and collect the tolls.
Private equity uses corporate tax shields to restructure the present, and venture capital relies on power laws to bet on the future. It's all connected.
Every single entity we've discussed is simply a different mechanism designed to solve the exact same problem, the deployment of surplus capital to generate yield.
Right.
But mapping out this architecture raises a vital question for you to mull over. We've established that this entire invisible machine, from commercial bank lending to venture capital power laws, relies on the continuous expansion of credit and the constant discovery of new markets. If the system is fundamentally built on debt that expects future growth, what happens when we reach the physical limits of that growth? Can an engine engineered entirely for constant acceleration ever safely reach an equilibrium? Or is it mathematically destined to either expand endlessly or face catastrophic collapse?
That is a fascinating and kind of terrifying systemic vulnerability to leave on, because the next time you look at the balance in your checking account, you'll know the truth about what those numbers actually represent.
They aren't just sitting there.
No, they are not just resting in a digital vault. They're working. Keep questioning the mechanics of how your capital moves, because understanding the architecture of this invisible machine is the key to seeing how the modern world is actually constructed. Thanks for joining us on this deep dive.